Good afternoon, everybody. Welcome to the weekly economic update for Monday, May 16th, 2022. Hope everybody had a great weekend. Pretty good weekend for Astros fans. They finally did break their 11-game win streak on Saturday. They threw up a dog on Saturday night. It was pretty ugly. I think they lost like 11-6 or something like that. It wasn't even that close. But came back yesterday and kicked some butt. Whooped the Nationals pretty good for the getaway day. Headed up to Boston, and that should be a good game tonight at 5, probably about 5, a little after 5 o'clock Mountain Time, 6 for my Central Time Zone folks. So kind of a gloomy day here in Colorado. We're expecting a week of rain and possibly a little bit of snow on Friday. So nothing, it's not going to get too cold, maybe in the 20s, but depending upon what time of day it falls, we might get a little more white stuff on the ground. So yay! All right, well, let's go ahead and take a peek and see how the indexes did today. It was kind of a back and forth day in the markets, but let's see how they ended up. The Dow Jones finished flat. It was up 0.08 at 32,223. S&P 500 finished down 0.39 at 4,008. NASDAQ was down 1.2%, closing at 11,662. Small caps are down about a third. The VIX retreated again today, another 4.85%. It's currently sitting at 2747. Still a pretty high number on the VIX. So I would expect the VIX is probably going to go a lot higher before all this is said and done. But we'll see what the future holds. All right. The other exchanges here in the Americas, Canada was up 0.53. Brazil was up 1.22. Mexico was up 1.95%. Moving over to Western Europe, Germany was down 0.45, the UK up 0.63, France down 0.23. The Euro stocks finished down 0.49. The Netherlands were up 0.07. Spain was up 0.19. Italy down 0.06, so basically flat. Switzerland was up 0.19, Portugal up 0.64, and Belgium up 0.59. Moving down further, looks like the Russian exchanges were up 2.47 and 3.69. Moving on down to the Asian markets, Japan was up 0.45, Australia was up 0.25, New Zealand up 0.46. Most of the Chinese markets were down. The Shanghai was down 0.34, the SESE component down 0.59, the China A50 down 1.03, and the DJ Shanghai down 0.45. And the Seoul up Chinese market, the Hang Seng was up 0.26, and the Taiwan weighted finished the day up 0.43. All right. So let me bring up my chart, and we can see this was the Dow. Started out most of the day until about 1 Eastern, then it broke above and got about almost 1% up, but finished the day flat. Similar chart for the S&P 500. It actually went further into the red. Dow Transports was in the red most of the day, and the Dow Utilities, I guess that has a lot to do with the price of energy, was mostly in the red all day long. So, all right, let's close that down and bring up the weekly economic update. All righty. All right, the week on Wall Street. In a volatile trading week, stocks extended their losses as economic growth and inflation concerns soured investor sentiment. The Dow Jones average dropped 2.14%, while the S&P 500 lost 2.41%. The NASDAQ fell 2.8%, and internationals fell 3.21%. A turbulent week. Inflation moved to center stage last week with the release of April's consumer price index and the producer price index, both numbers near their 40-year highs, but were lower than March's year-over-year numbers. The result heightened investor anxiety about future Fed money tightening and its impact on economic growth. In recent weeks, technology stocks have borne the brunt of the downdraft as investors lightened up on risk exposures, with some of the mega cap tech names getting swept up in the selling pressure. Cooling import prices increased, buoyed spirits on Friday, helping spark a rally that reduced the week's losses. Inflation is staying hot, and investors were greeted with mixed CPI report, looking for signs that inflation may be cooling. Year-over-year costs rose 8.3%, slower than the previous month, but faster than the consensus estimates. Excluding food and energy, core inflation climbed 6.2%. Buried beneath the headline number was a 5.1% yearly increase in shelter costs. The most significant increase since 1991. Shelter costs account for 1/3 of the CPI. Inflation has been a weight on the markets all year. Investors are concerned that the persistence of higher prices may tip the economy into recession as increased spending on essential needs crimps consumer spending power. Got some economic data coming out this week. On Tuesday, we have retail sales and industrial production. Wednesday, we have housing starts. And on Thursday, we have existing home sales, jobless claims, and the index of leading economic indicators. Also got a bunch of companies reporting earnings this week. Tomorrow on Tuesday, we have Walmart and Home Depot. Wednesday, we have Cisco, Target, Lowe's, TJX, and Analog Devices. Thursday, Applied Materials, Palo Alto Networks, Ross Stores, and Friday, John Deere. All right. Also going out this week to those on my mailing list is the Retirement Insight. I got a couple of subjects in here that we should probably cover. Rethinking retirement. Some of the conventional financial wisdom circulating about retirement may need a second look because those assumptions may not prove true for everyone. Or to put it another way, sometimes people think about retirement conveniently rather than realistically. Many people assume they will retire as they choose, purely on their terms. Is that how it usually happens? Not really. Not in my experience dealing with people over the last 15 plus years. The Employee Benefit Research Institute's 2021 Retirement Confidence Survey indicates otherwise. The average retirement age is 62, yet most workers expect to retire at 65. While 59% of workers believe they can ease into retirement via part-time work, just 19% of current retirees have. As for working in retirement, 72% of pre-retirees expect to do so, yet just 30% of retired survey respondents said they earned income from employment or freelancing. You still hear about the 4% rule for retirement income withdrawals, withdrawing 4% a year off your retirement assets, but one size rarely fits all. One of the most complicated and essential calculations is figuring out how much money you can withdraw from your retirement account. Finally, you sometimes read articles that tell you to save at least $1 million before you retire. Well, let me stop there. $1 million saved up will only create $30 to $40, maybe $50,000 a year in income. So, $1 million doesn't go real far when you're trying to preserve the principal for future income down the road. So, $1 million, it may seem like a lot of money, and it is a lot if you're going to spend it all at once. But if you're trying to have that nest egg last a lifetime, $1 million on the most conservative side will give you about $30,000 a year. On the most aggressive side, up to about 50. So, I like to use a 3% rule when, talking with people, especially if I'm using very vague numbers, until I really have a chance to dive in and do the analysis. But anyways, diving back in, it's important to remember that anything you have saved in retirement account is better than nothing. But the more you can put away now, the more you have later on. All right. Some travel tips. If you're going on a trip of several days or longer and post real-time photos on social media, you may be letting some people know you're not at home. If you or your kids tell online friends or followers you are leaving on a long trip on a particular date, the same applies. Remember that property crime involves both motive and opportunity. If you have any concerns about the safety of your home or small business while you travel, wait to post those trip photos until after you return. Probably a good idea, folks. You don't want to let the whole world know that you're not home and there's no one there to stop them if you break in. All right, next subject. How much do you know about elder care? Elder care takes different forms: nursing home care, assisted living, adult daycare, and even some forms of health care administered at home. According to Genworth's most recent study of U.S. elder care costs, a private room in a nursing home now costs an average of nearly $9,000 a month. A one-bedroom assisted living unit on average demands about $4,500 a month. Even home health aides cost about $25 an hour. Medicare will not pay for long-term custodial health expenses, so some households look to into insurance solutions. In 2021, according to the American Association of Long-Term Care Insurance, the average annual premium for extended care policy issued to a 55-year-old couple was about $5,025. That may seem costly, but ongoing nursing home care is much more expensive. You may want to consider checking into payment choices now with the future in mind. Years from now, you and your loved ones may be glad that you did. All right, that was about all the interesting stuff I wanted to share there. Next white paper going out is what is an annuity? Most of y'all have been working with me a while. You probably already have had been taught this, but for anyone who's new to this, I'm gonna read through this and give my own little simplified version of it. Individuals hold about 2.5 million in annuity contracts, a tidy sum considering an estimated 12.2 million is held in all types of IRAs. Annuity contracts are purchased from an insurance company. In exchange, the insurance company makes regular payments to the buyer, either immediate or at some future date. These payments can be made monthly, quarterly, or annually, or in a single lump sum. Annuity contract holders can opt to receive payments for the rest of their lives or a set number of years. The money invested in an annuity grows tax deferred. The amount contributed to the annuity will not be taxed when the money is withdrawn, but earnings will be taxed as regular income. There is no contribution limit for an annuity. Well, let me stop there. If you have an annuity inside of an IRA, all proceeds that you take out will be taxed because because you already have it inside that IRA shell or wrapper. Think of it as a box with wrapping paper around it, and that IRA is the tax deferment around that account. So if you take those funds and move it into an annuity inside of an IRA, then when you take, say, $5,000 a year out of it, you're going to pay income tax on the regular income tax on the entire withdrawal. There's two main types of annuities. Fixed annuities offer a guaranteed payout, usually set at a set dollar amount or set percentage of assets in the annuity. Variable annuities offer the possibility to allocate premiums between various sub-accounts, which it's kind of like your 401k. The big difference there is, with a fixed annuity, it's got a fixed, percentage, that you're going to earn on that money while it's accumulating. For example, think of it typically as like a bond. If you're getting 2, 3, 5%, it's a fixed amount for the life of the contract. With a variable annuity, it's more like having a 401k inside of there where you're able to invest in, equities, stocks, bonds. If they have sub accounts that are in, say, gold, silver, other currencies, depending upon the insurance company will depend upon how much or how diverse your investment choices are in a variable annuity. So, and they also have options that are, a lot like in your 401k, where you might have a risk-based models that are from conservative to aggressive. Or time dated, where if you retire in, say, 2030 or 2040, the risk gets lower as you get closer to that date. So again, different companies offer different have a different catalog of investment choices. So anyways, so that's the basis of an annuity. I'm not going to go into the case study here. So if it's linked here in the notes or in the show notes, so if you want to read it at your leisure, feel free. All right. Next one, how to buy I bonds direct from the Treasury. I bonds are bonds that are indexed for inflation, so it gives you some inflation protection. So, all right. So let's dive into this. With inflation hovering at near 40-year highs, some investors are looking for an alternative way to weather the storm. For many, Series I savings bonds are just the ticket. I bonds give an investor a rate of return plus inflation protection and are backed by the U.S. government. See, that part, I don't know if that's necessarily a good thing. I-bonds are pretty simple to set up. You go to the treasurydirect.gov, open a free account to purchase these federally backed securities directly from the U.S. Treasury. First thing you do, make sure you have the following close at hand: your taxpayer identification number, current address, checking or savings account information, and an email address. Go to treasurydirect.gov's website, navigate to the bottom of the page, and select Apply Now on the left. This will begin your account creation journey. Next, you will choose between an individual or an entity account. Select individual account type. It's the default option, and click Submit. Using the information gathered in step 1, fill in the fields requested and check at the bottom to certify your taxpayer ID number. Click Submit. Take some time here, or select a personalized image is the next step. Take some time to select an image and caption you will remember. This is a visual password for your account, and then click Submit. Secure your account. Select your password and security questions on this screen. Make sure to answer any questions and make sure your security questions are impossible to guess but easy to remember. Click Submit. And finally, look for your Treasury Direct account number in your email. You'll need this to log into your account later. And once you get an email from the Treasury, you can then log in and make your purchases. But keep in mind, you can only buy up to $10,000 per calendar year. I guess they don't want everybody putting all their money into something that's going to be inflation protected, because then everyone else gets screwed. All right. And the last white paper I have going out today, couples retiring on the same page. What does a good retirement look like to you? Does it resemble the retirement that your spouse or partner has in mind? Is it roughly similar? The Social Security Administration projects an average retirement of 18 years for a man and 21 years for a woman, assuming they both retire at 65. So sharing the same vision of retirement, or at least respecting the differences in each other's visions, seems crucial to retirement happiness. What kind of retirement does your spouse or partner imagine? During years of working, parenting, and making ends meet, many couples never really get around to talking about what their retirement should look like. If spouses or partners have quite different attitudes about money or dreams that don't align, the conversation may be deferred for years. Even if they are great communicators, assumptions about what others want for the future may prove inaccurate. Are couples discussing retirement or not? According to a recent survey by Fidelity, 7 in 10 couples say they communicate at least very well with their partner about financial issues. Couples that do communicate with each other are more than twice as likely to report they expect to live comfortably, a comfortable lifestyle in retirement. They also are also more likely to report their financial household's financial health as excellent or very good. If you're having trouble building a retirement strategy with your significant other, working with a financial professional, I know somebody, may help. According to the same survey, couples that work with a financial professional are more likely to talk about money with each other, feel confident about their finances, and agree on their visions of retirement. This may explain why nearly half of all baby boomers work with financial professionals. Yeah, I've had some conversations over the years where people were completely on the opposite page, and having some fights in your conference room is not a fun thing to be sitting there across the table from. And it's like, whoa, y'all should have had this conversation before you sat down in here. All right. Be sure to talk about the future that you want. A few simple questions can get the conversation going. You might even want to chat it over a meal or coffee in a relaxing setting. Dreaming or strategizing together, even on the most basic level, gives you a chance to reacquaint yourselves with your financial needs, goals, and personalities. To start, ask each other what you see yourselves doing in retirement, individually as well as together. Is the way you are saving and investing conducive to those dreams? Think about whether you're making the most of your retirement savings potential. Could you save more? Do you need to? Are you both contributing to tax-advantaged retirement accounts? Are you comfortable with the amount of risk that you're assuming? If your significant other is handling the household finances and the meetings with a financial professional about retirement strategy, are you prepared to take over in case of an emergency? When one half of a couple is the hub for money matters and investment decisions, the other spouse or partner needs to at least have an understanding of them. Something I do try to do. I can't always force people to show up for their meetings, but I personally, I like if it is a couple, having both of them in front of me or on the video screen and at least talking things over, because you definitely don't want 20 years to go by and then they're like one person's expecting one thing and then the other, and then you have a big fight, divorce, and all that stuff. That's not fun. Speaking of knowledge, you should both know who the beneficiaries are for your retirement plans, workplace retirement accounts, and investment accounts, and you both need to know where the relevant paperwork is located. Really good advice there. All righty, let's dive into today's market recap. I had a bunch of white papers, so it's a little late in the broadcast. I apologize, but is what it is. S&P 500 pairs losses as choppy trade continues. Choppy is not the word I would use. Written by our friend Yassine Ibrahim from Investing. The S&P 500 flitted between gains and losses Monday as gains in energy offset a Tesla-led slump in consumer discretionary stocks. Energy jumped more than 3% after oil clawed back earlier losses on fears of supply shortage as European members appear to be making progress on an agreement to ban Russian oil. Well, if energy is so expensive, that's probably not the best idea. APA, Marathon Oil, and Occidental Petroleum Corporation were among the biggest gainers, with the latter up more than 6%. Financials, meanwhile, were also a drag on the broader market, led by Signature Bank, as the cryptocurrency exposed bank reported a fall in deposits following a rout in crypto markets. Regional banks, meanwhile, were also nursing losses, adding to pressure in the sector amid growing bets of an economic slowdown following a weaker economic growth reported in China overnight. Quote, our conviction is that the chances of an outright recession in 2022 remain low, Wells Fargo said in a note. Quote, however, the probability has risen substantially that the economy would suffer a 2023 contraction, end quote. Consumer discretionary stocks were the biggest drag on the market, paced by more than 4% fall in Tesla. The big tech traded mixed with Apple, Alphabet, and Amazon in the red, while Facebook and Microsoft were up more than 1%. Twitter, meanwhile, shed more than 7% as investors seemingly price in the prospect of Elon Musk lowering his $44 billion bid to take the company private, or ultimately walking away from the deal. Musk said last week the deal to buy Twitter was on hold, citing concerns about fake accounts on the social media giant. The move was widely viewed as a gambit to negotiate a lower price. Probably. That's what I would do if you had all this fake crap on a business that I was buying. I think the bigger issue is that a lot of the blue hair weirdos who hate anyone to the right of Marx, they're the ones really pissed off about Elon buying this. But anyways, on the economic front, regional manufacturing data flagged added to worries about an economic slowdown after reading a manufacturing activity in New York fell by 36.2 points to negative 11.6 in May. In other news, JetBlue Airways fell 4% after tabling a $30 per share offer for Spirit Airlines after its previous offer for the company was rejected. McDonald's, meanwhile, fell 2% after announcing it would sell its restaurants in Russia, leading to a $1.4 billion write-off. Well, it's probably better for the Russians. I mean, McDonald's is terrible for you. The wild swing on Wall Street following a rebound last week is expected to continue. Quote, we expect range-bound choppy glide path for stocks in the week ahead, with support still near a 30-month moving average on the SPX and a resistance towards the 43 to 4,500 range, said Janie Montgomery Scott in a note. So again, more of the same, just a lot of bounty, up and down in the markets. It is to be expected. Our government and the Fed has put us in this situation, and I'm sure they like pointing the blame at everybody else, but this is purely on their shoulders, and do not let them forget. All right, this article comes from First Trust. Brian Westbury is their chief economist. His article is titled "Recession Unlikely in 2022." The consensus among economists puts the odds of a recession starting sometime next year at 30%, according to Bloomberg's most recent survey. No wonder the S&P 500 is in deep correction territory and flirting with an official bear market. We think the near-term pessimism is overdone. Yes, a recession is likely on the way, but it probably has about 2 more years before it arrives. Wow, Brian. Whew. I think it's going to happen sooner, but hey, you're the economist. I'm just merely the investment advisor. Plenty of reasons suggest we are not about to have a recession that starts in 2022 or early 2023. First, the most probable cause of the next recession is tighter monetary policy needed to wrestle inflation under control. But so far, monetary policy isn't tight. Well, that's true. The Federal Reserve has raised short-term interest rates by less than 1 percentage point, and although it's been announced, quantitative tightening has yet to start. Yes, the growth in M2 measure of the money supply has slowed recently, but the time lag between tighter money and the slower economic growth should be at least 12 months. Second, tax rates haven't gone up and are increasingly unlikely to do so anytime soon. The gradual demise of President's Build Back Better agenda means tax rates remain at the lowered levels set by the Tax Cuts and Jobs Act, which was enacted in 2018, and I think they expire in 2028. Third, although businesses are replenishing inventories at a rapid pace, a pace that will eventually slow and then reduce the real GDP growth rate, the levels of inventories at manufacturers, retailers, and wholesalers are still very low relative to sales, which means plenty of room for businesses to keep restocking shelves and showrooms in the months ahead. Fourth, although higher mortgage rates will almost certainly be a headwind for home sales in the months ahead, home builders have underbuilt housing in the past decade, and so total home construction should not falter significantly. Fewer home sales, yes, but rental units have been built too. Fifth, there were 11.5 million job openings as of March compared to 7 million immediately prior to COVID. Demand for workers remains robust. Some investors fear the rise in long-term interest rates and drop in stocks all by themselves represents a form of financial tightening that could tip the economy into recession, but the size of the recent movements in financial markets have not been automatically linked with recessions in the past. Meanwhile, debt service costs are low for both consumers and U.S. companies, as the fourth quarter consumers needed only 14% of their after-tax incomes to meet financial obligations, which are debt service payments plus rents and payments for car leases and similar costs. For comparison, that's lower than it ever was pre-COVID, dating back to at least 1980. We track debt services, debt securities, and loans of non-financial companies relative to their assets, as well as their net interest payments relative to their profits. Both measures are low by historical standards. Again, we want to be clear that we are not dismissing the risk of recession. He's aware it's going to happen. He just is thinks it's going to happen a little bit later than I personally do. Again, we want to be clear: we're not dismissing the risk of recession. We think one is on the horizon, given the over loose stance of monetary policy in the past couple of years and the response necessary to correct the resulting inflation. But market pessimism has gotten ahead of itself, and there is room for economic news to come in better than expected in the immediate year ahead. Well, Brian, I mean, personally, I'd rather go through it sooner than later, just because, sooner it happens in my life, it gives me more time to rebuild and also for, clients, it's just, stagflation or, stagnant economy drags out for a number of years before we actually go into recession. I mean, it's going to be like the 70s all over again. And I don't know if anyone wants to really go through that. So I know I don't. I mean, the clothing was terrible in the 70s. You see how those bell bottoms and those awful rayon shirts? Anyways. All right. Well, that's everything I had for today. I hope everyone has a fantastic evening. I'll be back tomorrow with the Liberty Call. If anybody needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And have a terrific evening. Bye, folks.